Private equity secondary market has evolved from a liquidity backstop into a strategic tool for general partners, GPs. Among the most transformative developments is the rise of GP-led secondary transactions, which allow GPs to extend ownership of assets, reset economics, and offer liquidity to limited partners, LPs. As these deals become more common, LPs face new considerations, especially around distributions, governance, and alignment. This article breaks down what's changing for LPs, what to watch for, and how fund administrators and other service providers can support better outcomes. What are GP-led secondaries? GP-led secondaries typically involve a GP transferring one or more assets from an existing fund into a continuation vehicle. LPs in the original fund are given the option to sell their interest for a price set by a third-party buyer, usually a secondary fund, roll their interest into the new vehicle, often with revised terms, or do nothing, depending on the structure. These transactions aim to be win-wins. GPs retain exposure to high-performing assets, while LPs gain optionality, but there are nuances. Distributions. The shift from cash to choice. Traditionally, LPs expect distributions in the form of cash, realized proceeds from asset sales. GP-led secondaries complicate this expectation. Distributions may be delayed if assets are rolled into continuation vehicles instead of sold outright. LPs may receive proceeds from secondary buyers, but pricing can be influenced by deal structure, timing, and market appetite. Tax treatment and reporting may differ depending on whether LPs sell or roll, adding complexity to fund administration. For LPs, this means distributions are no longer just about timing, they're about decision-making. Fund administrators must be prepared to support nuanced elections, track multiple classes of LPs, and manage bespoke reporting. Governance and transparency challenges. GP-led deals often raise governance questions. Who sets the price? Secondary buyers may negotiate directly with the GP, creating potential conflicts. Who represents LP interests? Some deals involve fairness opinions or LP advisory committee (LPXO) approvals, but practices vary. Are LPs adequately informed? The quality and timing of disclosures can impact LPs' ability to make informed decisions. LPs increasingly expect clear, timely communication, and administrators play a key role in facilitating that. From election notices to capital account statements, precision and clarity are essential. Alignment and economics. Rollover LPs versus new entrants. When LPs roll into continuation vehicles, they often face new terms. Fee resets may benefit the GP, but dilute returns for rollover LPs. Carry structures may restart even if the GP has already earned carry on the asset. New LPs in the continuation vehicle may have different priorities or time horizons. This creates a bifurcated investor base with potential for misalignment. LPs must weigh the economics of rolling versus selling, and administrators must track these divergent paths accurately. Conclusion: LPs need more than optionality. They need clarity. GP-led secondaries are here to stay, and they offer real benefits. But for LPs, the shift from passive distributions to active elections introduces new risks and responsibilities. Fund administrators, legal counsel, and placement agents all have a role to play in ensuring these deals are executed with integrity and precision. As the market matures, LPs will increasingly demand not just liquidity, but clarity, fairness, and alignment. The firms that deliver on those expectations will set the standard for the next generation of private equity operations.